Welcome once again to a weekly look at gold market fundamentals with David Jensen. Thanks for joining me again, David.
My pleasure, Jay.
You know, we were talking earlier this week about Gresham's law, and in connection with the topic that we've been talking about so frequently on our weekly conversations having to do with the LBMA, the paper markets in gold as opposed to the real markets for real physical gold. Help us understand the connection, David.
Yeah, sure. Gresham's law is a historical observance and looking at monetary systems over the ages, and it's simply stated as bad money drives out good. And what that statement means, historically, regimes, empires have typically resorted to diluting their currency, what we call nowadays inflation, and diluting their currency, debasing the currency to make it go further. So what they've done historically when they used gold and silver as money was that they would add base metals such as copper to their gold and silver coins and put them into circulation. And what the statement bad money drives out good means is as the new money, which is diluted or debased, goes into circulation, but with the same face value as the older money holding higher amounts of precious metals, would be the good money. As the new money goes into circulation, it would drive out of the market the good money. People would hoard the money which contained greater amounts of gold and silver and continue to spend the new debased currency in the market. Mm-hmm. So and this happened in the Roman times and in numerous other times as empires were in decline and they resorted to debasement of currency. Now, when we look at gold and silver, they are money. J.P. Morgan said that 100 years ago, and Alan Greenspan said that recently in the fall of 2014, where he said that gold is superior currency to all fiat currencies, including the U.S. dollar. So now when we look at the issue of debasement of metals in the markets, we look at what is going on at the LBMA as really bringing Gresham's law into play as a way of explaining what is going on in the LBMA.
Right. So we've talked about this frequently. It's sort of a fractional reserve system, isn't it? Where lots of people think they own gold, and all they own is a claim against gold. Not even a claim against gold, but claim against another piece of paper, essentially, on the LBMA, because the LBMA isn't required to pay back in gold, right? They can pay back in currency. Do I have that right?
Well, the COMEX has numerous loopholes in its rule book allowing for settlement in cash. Now the LBMA, that's unallocated. Sorry, that is a over-the-counter market, mm-hmm. And an OTC market. Each contract is different, but typically, what they allow for is trading of physical gold and physical silver and taking possession of it. Now, what they're doing in London is that they're trading unallocated gold and silver, where you have fractional reserve or 1% of the metal that's actually backing the positions. Mm-hmm. And this unallocated gold or digital or virtual gold and virtual silver, that really equates to the bad money in Roman times of the diluted or debased money, because you have only a fraction of the real thing there. And it is this unallocated gold and unallocated silver which the LBMA says accounts for the vast majority of the spot trading and accounts for the vast majority of the open interest. So, as we've discussed in weeks past and recently, Jay, you have an expandable gold and silver account there where people think that they're sitting in gold and silver. But they really aren't. They're sitting in unallocated or virtual instruments. Mm-hmm. Now, the reason that we keep circling back to the LBMA is that the LBMA says that it is the basis for virtually all transactions in gold, silver, platinum, and palladium. The pricing set by the LBMA is the basis for that. So all the mining companies and the vast majority of financial transactions that refer to gold, silver, platinum, and palladium rely on the London market to set the price. So, back to the point again about bad money and good money is that, if they're trading these unallocated instruments or bad money, what the LBMA is going to result or have as a result is that it's going to drive the good money, the good assets of gold and silver, the bars. It's going to drive them, it's going to cause hoarding, and they will disappear from circulation. And what happens then is that the LBMA is going to cease functioning as an exchange, because by introducing their own vastly diluted instruments, they're going to drive the real metal from the market and result in the lockup or the failure of the LBMA as an exchange.
Mm-hmm. But as long as people still believe that they have those pieces of paper, and as such they believe that they still own the real thing, then the con game can go on for some time, right?
Well, it has for decades, but the problem is that this was ever introduced to the market, because the day that it was introduced, it spelled the end of the LBMA because of Gresham's law. You know that this is going to expand with time, and ultimately that it's going to drive metal out of the market. In the meantime, it will result in a short-circuiting of the pricing structure of gold and silver, platinum and palladium. So it will result in the short-circuiting of the market pricing of these instruments and allow for decades of a credit bubble to be blown. But in the end, it means market failure, and the day the LBMA failed was the day, can be traced directly back to the day that these instruments were introduced to the LBMA.
Well, that's the way you see it, that's the way I see it, but that's not the way most people see it. And my point is that as long as they continue to believe in the system, the con game can continue. But I mean, there could be any number of things that could cause it to end. You and I have talked about lots of different things that could bring about this loss of confidence. I don't know if you'd care to maybe speculate on some at this point in time.
Well, I mean, let's look at the table we put together last week, and we discussed the open interest of the positions of 400 million to 600 million ounces of gold, the claims in the market, and the claims of silver being about 3.5 to 5 billion ounces of silver of claims in the market versus, for silver, all of the global stockpiles are 0.9 billion ounces. I mean, you don't have to speculate too far to see where that can fail. You know that the market is going to sort this out, that you're going to have, due to mispricing, you have these assets disappearing from the market and liquidity disappears. So, what the proximal cause is, it's ultimately going to be that the fact that the metal and the gold and silver in particular will stop flowing in the market because of this mispricing. What it'll be blamed on, who knows? But we can see that there's numerous physical gold markets and silver markets being opened up around the world, and I think it's not just us that can see the problem with London, and parenthetically with New York as well. But we can see these physical exchanges opening up everywhere.
No doubt. Yeah. I'm sorry, David. Go ahead.
No, I just think I think in preparation, for the seizure of these other money-centered exchanges.
Because certainly at some point in time, if people really start to demand delivery of those metals, and they're not, the LBMA is not able to deliver it, then that certainly would be a breaking point, and I think it could happen fairly quickly.
Yeah, the Shanghai Gold Exchange is. Is having a dramatic impact on physical gold flows into China. I think the estimates were that there was 1,500 tons a year of gold being, net being consumed by China, imported, and I think around 1,000 tons into India, versus 2,900 tons a year of global mine production, which is the readily available gold to market. So, I mean, between those two markets, you're about 80% plus of the available annual gold production. So, and seeing, Dubai now is announcing that they are targeting the end of March to open up a new exchange, and that they stated in this article in Gulf News that their aim is to become a benchmark. The loco Dubai price would be a benchmark for all stakeholders in China, India, and Africa. So what we see here is that Dubai is gunning to become the primary exchange for Asia and African pricing of gold. And I think that when you combine the opening of Dubai with Singapore, Hong Kong, Shanghai, and Moscow, that are all functioning exchanges, that I think it'll be quite rapid that we will have this changeover to real trading and real pricing of these important metals.
Yeah, it's really interesting that omitted from that was any reference to Europe or the United States or South America as far as that goes.
Yeah, and I think that the writing is on the wall. I think that the geopolitics that we're seeing now, the agitation and the conflict that we see, and then just daring Russia to get into some kind of a conflict, it's just incredible. But if we look at the role of these very important monetary assets and the destabilization of them, and now the correction, pushing things away from the mean and then the return to the mean is going to be quite violent, I think, in terms of the price movement that we see. And I think that's what we see here is the scramble now to get these physical exchanges functional in time for what is coming of a new market.
Yeah, so people are perceiving Gresham's law and preparing for it. A few people, relatively few people, I would say, but probably some really smart, big money people as well.
Yeah,
but
bad money is sorry, Jay. Bad money is driving out good, and we can see this sweep of physicals being just vacuumed out of these out of London and these other. Primarily out of London and out of Switzerland, is being just drawn rapidly into Asia, that they clearly understand what's going on, and they are withdrawing the good money from the system. Mm-hmm. So I think it's underway. It's not really going to be a particular thing that does it. It's happening already, and the market is adapting, and we have new structures being set up to deal with it.
Mm-hmm. These bad money practices are coming from the West, essentially, headed up by the Federal Reserve Bank ever since, you could argue, I guess, with Roosevelt in the United States, and then for sure with Nixon in 1971. So it is the debasing of currency, the fractional reserve banking, all of these things we've been talking about with the LBMA, the sort of, not unreal gold and the virtual gold markets that we've been talking about, the LBMA and the COMEX. But some people are really trying to blame, would like to blame the BRIC countries for our problems, and would like to blame the BRIC countries for creating a nuclear bomb, I think is some of the language I've seen and some of the things I've read recently. Blaming those countries for what is to come. What's your take on that?
Well, the nuclear bomb, if we want to use that term, is the LBMA. That's the market that prices these assets globally. And we've seen indications that there's problems at the LBMA. The Germans, Deutsche Bank, withdrew from both the gold and the silver fix last year, and they withdrew without even selling their seats on the silver fix.
Yeah,
they just quit the market. So I think, when you see German bankers come running out of a building, you can maybe think that there's something going on there. And I think that the indications are that I think silver is really the key. And I think looking at this open interest, I can see why they were so anxious to get away from the silver fix.
Mm-hmm.
But the bomb or the destabilizing device is the LBMA and is the trading of these unallocated assets, instruments, and the enormous volumes of trading virtual things as opposed to trading real things and distorting prices. And again, Gresham's law says by definition that these markets will fail because they are introducing bad money into the system.
So what's likely to happen, David, at some point in time when confidence is lost?
Yeah.
What's likely to happen? What do you think?
Well, we've seen complete market failure before. One that's a little bit humorous in some aspects was what was called the Kuwait camel market, or the Souk al-Manak, in Kuwait, and it had really a spectacular rise and fall in the early 1980s. It did a round trip from a $5 billion market cap up to $100 billion and then back to almost zero. And at its peak, it had the third largest stock market capitalization of any market in the world. That's how crazy this market in Kuwait became. And how that really progressed was that they were using leveraged instruments, and there's that word again, leverage in the form of margin, but we're using leverage in London to create gold and silver that doesn't exist. And in Kuwait, they were using margin to create credit where it didn't exist, and there's that comparison again of using this margin to drive that market to just astronomical heights. But what happened was that it went on for a couple of years, and shell companies were opening at $1 billion market valuation, and as you said earlier, things just went on and on and on. But they went on until they didn't. And what happened there was that the trading was discontinuous in Kuwait on the camel market there. And what happened was that one day the markets opened and there was just no bid anywhere in the market. And so there wasn't really a crash. There just was zero valuation for these assets. And so what they had in the end was just the sound of crickets when the market would open up, and no bid, no activity, and no interest. And so I think that this is potentially what the LBMA is headed for, because the run is on for the real assets. We can see the flow into India and the flow into China and the flow into actually net into Switzerland as well. And so I think that the run is on. And the question is that at what point does the LBMA break, and at what point do these unallocated or non-existent instruments for non-existent metal, at which point do they show the insolvency of the parties trading there, of the big banks? And I think that the abandonment of the LBMA by some of the major banks is a sign that things are moving in that direction. And when they typically go precipitously. They go with a step change function.
It could go very, very rapidly, and I agree that the notion of a Kuwait camel market is a bit humorous, except that if you were one of the people stuck with that paper when there were no longer any bids, it wasn't so funny. So I guess the message I take away from this, David, is that you better get out while the getting is good. There will come a time when it won't be possible to exit your paper positions, perhaps, and that's why. I guess one of the reasons that I've been telling my subscribers all along, make sure that you have the foundation of your portfolio based on silver and gold, the real thing, as opposed to some of the paper products, even some of the things that I like a lot, like some of the mining companies. Having the real gold in your hand or in your possession, there's nothing that beats that, I guess, right?
Yeah, I think that a couple of points here is that the people that are technical chart followers of the price of gold and silver, I don't think they're going to see this coming because of the step change function which is involved here. And secondly, I don't see this as a trading opportunity because these guys have been monkeying with the capital markets globally.
Yeah.
And they're going to cause a serious problem on the global stage when this corrects. So I do encourage people not to think of this as, geez, we're going to get rich here. It's that there's a serious problem that's been created. They haven't addressed the issues. They've been encouraged to by numerous parties to correct what's going on, and there's no interest, no will to sit down and roll up their sleeves and restructure things. So the things that really need to be happening in terms of a write-down of the outstanding debt and a return to sound money is not going to happen because of the interests that are going to try to, that are in denial because they profit too greatly from the current system. And as a consequence, I think that we're going to have a Kuwait camel market type of result on the LBMA, where there's going to be a discontinuous trading in those markets.
Well, it certainly isn't something that we're looking forward to because of the turmoil and the strife that could follow with that. But But we want to look at reality as it is and try to prepare for it as best we can. I think people, when they think about they're going to get rich, as you said, people think they're going to get rich by holding and trading. When they think that way, they're thinking in terms of dollars. They're thinking in terms of the stable value being in the fiat currency. And history doesn't bode well for that line of thought, does it?
No, it doesn't. And back to the origins of this, I mean, the LBMA has been using leverage for decades. But when we look back to the root, I'd have to go right back to 1913 and the creation of the Federal Reserve and the creation of flexible money. And that whole concept of fractional reserve banking and flexible money where you create more money than there really is. I mean, there you are. There we have the root problem again is leverage.
Absolutely.
And it's unsound money and it's unsound practices which really have really built on on themselves over the decades now until we have a system now which is one that would really be unrecognizable to people like John Exter in terms of the leverage and what is going on and really the extend and pretend practices that we see from the central banks that are being used. It's not a solution.
Not only does it result in problems and the flexible money that is result in instability in the markets, it also results in dishonest gains, I think, and that's another topic for another day perhaps. But the whole notion of reallocation of wealth to the people that control it, the people that create this money out of nothing. If we had some sort of a gold standard, obviously that would be held in check to a great extent. Not saying human beings would be perfect, but we would have a system that would have a lot of safeguards against it. Is there anything else you'd like to add today, David, before we conclude our discussion? Any concluding comments?
Well, the concept of flexible money and the stripping of wealth. I saw an interesting study probably about 6 or 7 years ago from RBC here in Canada. And it was interesting to me that I believe the number is about 60% of their trading profits were made with sector trades. And so what they were saying was that they weren't rifle shooting and picking particular equities, but it was just being in the right sector. And so when you look at sector trading and the potential for leveraged profit for incredible gain, and really the concept of exponential growth, with interest rates, the year in, year out growth that you get when you leverage that up over a period of time. And then look at what Warren Buffett's done in terms of people think he's just incredibly brilliant. And I don't think he is incredibly brilliant. I think what he understood was the leverage game in the markets and central bank activity, and that he knew on a decade-long basis of what sector to be in. And so I think that, when you point to, you mentioned there the allocation of the reallocation of wealth and the gaining of other people's assets. I mean, that's all you really need to do is understand the big picture here, and you can line your pockets, and that's why there's so much resentment towards gold. I think Buffett says you mine it, dig it out of the ground, then you put it back into the ground again. But I mean, when you look at paper money and fiat money, it's just as ridiculous. There's no intrinsic value to a piece of paper or to a digit either. And the problem that they have with sound money is that you can't game the system.
Yeah.
And you can't create it from nothing, and you can't create bubbles the same way and then have panics and then benefit from the panics.
Right. You preserve capital through honest money. You destroy capital through dishonest money, and we're seeing an acceleration of that with the with zero interest rates and negative rates even. In fact, it's destroying capital and the capitalist system, I would argue even, which then I think is actually guaranteeing that the system is going to break down and there's going to be, out of necessity, a return to honest money, David. And I think the things you're talking about today, the formation of these new markets that are bent on trading the real thing, real money, the markets are demanding it. The masses don't recognize it yet, but those who get out ahead of the game and prepare themselves should be in a much better position when the system does fall down. Anything else today?
No, just the concept of compound gain. It's not there when you have a sound money system. It comes down to productivity and work and creation of value, and I think that's ultimately what we have to get back to, Jay.
Well, I think that's what the markets are sort of starting to direct us back to. again with these new honest bullion markets that you've been talking about, in Dubai being the one that's next to come online the way it looks.
Yeah, I mean, God help us if we have to rely on Dubai, to be honest.
Well, I guess you're right, but the laws of nature sometimes force the most dishonest people to be honest. You could make that case. I would make that case, in fact, for Vladimir Putin right now in terms of his move towards gold, possibly, and certainly a 17% flat tax rate is more honest than the one I have to pay here in New York. So, who knows? I think the natural laws, nature's laws, sometimes force people to straighten out sometimes, and I guess we have to hope and pray that's the case.
Yeah, I think natural law is attractive to people no matter what culture they come from, and I think that basically the concept of dishonest gain, the militating against it is strong in many cultures.
Sure,
and
of course.
And I think that what we're going to have now is basically a new world that comes forward, in which the understanding of the damaging impact of these games is understood. And I think that the punishment will be meted out to the markets that have been playing in the dishonest game gained the most.
Well, we have to maybe end it there today, David. Thank you for that very positive note that justice will be served ultimately through the markets, and well, we have to hope that that's the case. The question is the main thing is to be prepared for the time when the system breaks down. So thank you very much, David, again for your insights. Always appreciated. Thanks for your research and passing it on to our listeners.
Thank you, Jay.